Oh my goodness, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome, everyone. Today, we're going to dive deep into financial statement analysis. Think of this as getting a professional toolkit, one that lets you really evaluate how a company is performing. We're not just going to look at numbers on a page. We're going to learn how to read the stories those numbers tell, stories about a company's health, its stability, and ultimately, its success.
All right, so here's our game plan. We've got 5 key areas to cover. We'll start with the art of comparison itself. Then we'll look at short-term health, long-term stability, and of course, how to measure success. And finally, we'll wrap up with some really important user warnings you'll need to keep in mind. Let's get started. Okay, first things first. All meaningful financial analysis, and I really mean all of it, starts with comparison. A number by itself, let's say a company made $1 million in profit, is totally meaningless. Is that good? Is it bad? You have no idea without some context, right? Compared to last year, compared to a competitor. So to get that context, we're going to start by mastering the 2 most fundamental techniques, horizontal and vertical analysis. So let's talk about horizontal analysis, or as it's often called, trend analysis. The name gives it away, really. Think of it like you're looking at a company's photo album, flipping through the pages from one year to the next. You're looking at the data over time. Our goal here is to see the direction things are moving, and this is key, the speed of that change. So we're not just asking, hey, did sales go up? We're asking, okay, by how much did they go up? And is that growth speeding up, or is it starting to slow down? It's all about spotting the trends. Let's make this real with our example, Whitby Cereal Company. So take a look at these numbers. We're comparing 2024 to 2023. You can see total assets went up by 6.4%. That's pretty solid growth. But here's where the real story is. Look at how they paid for that growth. Total liabilities, they only went up by 2.6%. But now look at shareholders' equity, a massive 22.1% jump. What does that tell you? It's telling us that Whitby is funding its growth not by taking on more debt, but by using its own capital and profits. That's a sign of a company strengthening its financial footing, which is exactly what you want to see. Okay, let's do the same thing for the income statement. At first glance, things look good. Sales are up 8%. Great. But a sharp analyst would spot something interesting right away. Look at the cost of goods sold. It grew by 8.5%. That's actually faster than sales growth. That's a red flag. It makes you ask questions, right? Are their raw material costs going up? Is something inefficient in their production line? Now, despite that little pressure point, look at the bottom line. Net income is up almost 10%. So even though their main cost grew a bit too fast, they must be doing a fantastic job managing their other expenses to still pull off that kind of profit growth. All right, let's switch gears completely. If horizontal analysis was like watching a movie of the company over time, vertical analysis is like pausing on a single frame and studying every detail in that snapshot. What we do is take every single item on a financial statement and express it as a percentage of a base amount. For the balance sheet, or statement of financial position, that base is always total assets. For the income statement, it's net sales. This simple trick gives us an incredible view of the company's financial DNA for a single year. And this table just lays it out perfectly. You can see how these 2 techniques are partners, but they answer totally different questions. Horizontal is all about the trend. How have things changed from last year to this year? It's about the flow. Vertical is all about proportion. What is the relative size of this item right now? It's a snapshot of the structure. You absolutely need both to get the full picture. So let's apply this to Whitby's 2024 balance sheet. See how everything is now a percentage of total assets? We can see that total liabilities make up 77.9% of the company's assets. Let's put that in plain English. For every dollar of stuff the company owns, about 78 cents of it is financed with debt. The other 22 cents comes from the owners, the shareholders' equity. And you know what? This confirms exactly what we suspected from the horizontal analysis. We saw equity growing faster than debt, and here's the result. A stronger capital structure, leaning a bit more on equity. It's a really good sign. All right, now that we have our comparison techniques down, let's get into the diagnostic toolkit. We're going to start with liquidity ratios. This is all about short-term health. You can think of it as financial first aid. The core question we're trying to answer is simple. Can the company pay its bills that are due, right now or in the very near future? Yeah, these ratios are basically the vital signs, like the pulse and blood pressure, of a company's immediate financial health. Imagine you're a supplier. You just sent a huge shipment of oats to Whitby Cereal, and they've promised to pay you in 30 days. You better believe you're going to be looking at these liquidity ratios. They tell you how likely you are to actually get your money on time. It's all about measuring a company's financial breathing room. Okay, so here are three of the big ones. The current ratio gives you that high-level snapshot of their ability to pay short-term debts. But the other two, the turnover ratios, they dig deeper. They're about efficiency. Receivables turnover tells you how quickly the company is collecting the cash it's owed from customers. And inventory turnover tells you how fast they're selling their products. I mean, you don't want inventory just sitting in a warehouse collecting dust, right? That's cash tied up. A high turnover for both of these is usually a very good sign. So we've checked the company's short-term pulse. Now it's time to zoom out. We're broadening our horizon from can they survive the next month to can they survive the next decade? We're talking about long-term stability, and that is the world of solvency ratios. Yeah, solvency is all about the big picture. It helps us understand if a company is built on a solid foundation of rock or if it's on a shaky foundation of sand. It's about sustainability. Liquidity was about paying this month's bills. Solvency is about having the strength to pay off all its debts and thrive for years and years. This is what long-term bondholders and shareholders care about most. Okay, let's look at some key solvency ratios. Debt to total assets is pretty straightforward. It tells you how much of the company is financed by debt. A higher number generally means higher risk. But my favorite here is times interest earned. This one gives you a much richer story. It shows you the company's buffer. So if this ratio is, let's say, 10, that means its operating profit is 10 times bigger than its interest payment. That's a huge cushion. It tells you they can easily cover their interest costs. And then there's free cash flow, maybe the most honest number of all. It's the hard cash left over after running the business and reinvesting for the future. All right, so we've checked for immediate health problems with liquidity, and we've assessed long-term stability with solvency. Now we get to the main event, profitability. After all is said and done, is the company actually good at what it does? Is it successful in its mission to make money and create value for its shareholders? Now, I want you to think about profitability not as a single number, but as this cascade. It's a chain of events. It all starts with the profit margin. How much do you make on each dollar of sales? Then you factor in asset turnover. How efficiently are you using all your stuff, your assets, to generate those sales? Put those two together, and you get return on assets, which is a great measure of overall operational profitability. But the cascade doesn't stop there. The final step is return on equity, which shows what that performance means for the actual owners of the business. And here are the formulas. What this really shows is that there's more than one way to be profitable. You could have a really high profit margin, like a luxury brand, but if you don't use your assets well, your overall return could be weak. On the flip side, think about a grocery store. Their profit margin on a can of soup is tiny, but they make up for it with incredible asset turnover. They sell a massive volume of stuff, and that can make them incredibly profitable. Ultimately, though, many people look to ROE, return on equity, as the final report card because it shows the return being generated for the people who own the company. So if you're an investor looking at the stock market, you need to translate the company's overall performance into terms that matter to you. That's where these ratios come in. Earnings per share, or EPS, takes that big net income number and boils it down to a per-share basis. The PE ratio connects those earnings to the stock price, giving you a feel for how the market values the company. And the payout ratio and dividend yield, they're all about the cash. How much of the profit is actually coming back to you, the shareholder, as a dividend? These are the ratios that really bridge the gap between the accountant's report and your investment portfolio. Okay, we've covered a lot of powerful tools, but before we wrap up, we absolutely have to talk about the user manual. Every powerful tool comes with warnings, and financial ratios are no exception. It's so important to remember this. A ratio isn't an answer, it's a question. And honestly, using these tools without understanding their limits can be worse than not using them at all. This is where professional judgment really comes into play. For example, if you're looking at a huge, diversified company that does everything from making jet engines to running a TV network, who do you compare them to? There's no clean industry benchmark. Then there's the issue of accounting policies. Two companies can make different choices, perfectly legal choices, about how they account for things like inventory or depreciation, and it can make their results look wildly different. This is why you always have to read the footnotes in the financial statements. The devil is always in the details. This chart is a perfect example of what I'm talking about. You could have two companies that are identical in every single way, but they can report different profit numbers just because of an accounting choice. Take inventory, for example. In a time when prices are rising, if one company uses the FIFO method, it will likely report higher profits than a company using the weighted average method. Neither one is wrong. They're both allowed, but as an analyst, you have to be smart enough to recognize this and adjust for it if you want a true comparison. And this quote really nails it. At the end of the day, financial analysis is as much an art as it is a science. The numbers give you the paint, but you, the analyst, have to paint the picture. Deciding if a huge one-time gain from selling a factory is part of the core business or just a fluke, that requires judgment. It requires you to look beyond the spreadsheet and understand the story behind the numbers. So I'll leave you with this question to think about. We've talked a lot about the numbers, but what about the things you can't easily quantify? Things like the quality of the management team, the power of the company's brand, or how tough their competition is. The financial ratios are like a doctor's x-ray. They give you an incredible look inside. But a full diagnosis and a truly complete evaluation of a company requires you to look at the whole patient, not just the scan.